Hello, everyone. My name is Peter, and I thank you all for joining us in this Murmia event today. And the topic of this session is the role of AI within market risk. And after a few introductory remarks, I will introduce my co-presenter, Jonathan, who is presenting most of the work of this session. So when I talk about financial market risk, I mean this from a regulatory pillar one perspective, which is the classical task of finding tomorrow's or range for tomorrow's P&L, maybe of your complete trading book, one day, so to say, one day into the future. And of course, there are multiple ways to accomplish this task, but all more or less are related to time series modeling. But wait a moment, how can AI assist us within time series modeling? So the big success stories in recent years circle around AI or machine learning used within speech, within text, LLMs, or within videos or pictures. But what about time series data? Of course, there are methods from the AI realm which try to cope with time series data, but they are mostly okay for small noise levels and also for areas which have a very slowly changing characteristic. But as you may all know or recall, that time series data from financial markets is quite noisy. There's a very low signal to noise ratio and is quite instationary. So I have to say, based on my experience, advanced AI techniques have no, at least in this case, no real advantage over classical time series models. And I guess indeed a regulator is, let's say, anxious to assess or to discuss AI within the realm of risk models because of these features. So when I say that this may not be the good point for the usage of AI, I have also to add that since we are in the market risk area, you know, this fundamental review of the trading book, we are moving towards standardized approaches. Of course, there is not much to learn within a standardized approach. And also the topics of explainability and audibility. I guess the industry is making good progress on this, but still it may not suffice to fully meet regulatory expectations in this area. And then as a last point, you know, I'm advancing points which more or less speak against the usage of AI within market risk, but let's see, we will have a good discussion on this. The last point would be that by definition, tail risk is a very interesting use case for AI because you are talking about rare events, and since some AI or machine learning techniques need a lot of data to get to certain conclusions, maybe tail risk is not the use case, the big use case for machine learning approaches. But then again, you have to see that also classical statistical procedures may also not be in a position to cover or fully cover tail risk. Within this area, you always have to have some sort of complementary qualitative approach. But that is all on the, so to say, negative side. On the positive side, of course, there are use cases for AI and machine learning. And you remember Joe's introductory remarks on being clear about what you are talking when you're talking about AI or machine learning. There are some use cases which circle around the process automations, for example, data quality checks, or anomaly detection or automated parts of validation and risk monitoring. Also, you can try to speed up your risk analytics by, for example, trying to learn the relationship between your hundreds of thousands of instruments and your tens of thousands of risk factors within your portfolio. And also monitoring and diagnostics will profit a lot from these topics. But that's for me for these introductory remarks. So you see, I've one issue or one point to make that an unreflected use of AI within market risk may not be the most optimal way to go. But now let's hear Jonathan's voice. Jonathan is CEO of Delta Vega Incorporated, a financial consultancy in New York, which offers servicing in pricing, risk management, and governance. He's doing ongoing researches in model risk management of large language models, benchmarking of personalized investing, and this is one of the topics of today, error bars within AI. So that's sounds very interesting. Let's see. Jonathan is lead author on the forthcoming textbook, a first course in model risk validation and model risk management, and he has over 26 years of quant experience across Wall Street in asset management, hedge funds, and insurers. So, Jonathan, the stage is yours.
Thank you, everyone, and thanks to all the speakers earlier today. I've been traveling around Brooklyn, but caught most of the talk. Some with a laptop on the seat of my car, but now I'm in a stationary place. Right. So I'm going to tend this talk a little bit more towards asset management, which is more lightly regulated. In the U.S., for example, the Securities and Exchange Commission is more the focus than the Fed. I'll say a little bit about the sell side, but at least in the U.S., it looks like much of the adoption is actually on the buy side. I'll give some examples of that. So then, in terms of VAR, one is thinking more about economic capital than about regulatory capital. I'll also talk about some risk measures beyond VAR that are tailored to asset management, such as the Sharpe ratio. Let's see. Next slide, please. I can't turn my own slides, right? So the first thing, just stepping back and talking about statistics, is that risk metrics are random variables. And so as usual, we're computing sample statistics, but estimating true population statistics. So therefore, as Peter said, both standard errors and confidence intervals need to be quoted with anything. Just to take it in the context of equity data, typically we'll only have 250 data points. Peter had a chart with 1,000 data points, so effectively 4 years. But, we could really do low latency things and examine things second by second. So we have this idea that we're taking a small sample of a much larger sample. The other aspect for AI is, of course, that there are two samples. There's the training sample and there's the test sample. So not only can there be standard error in each of those, but they can add. If they were in general, uncorrelated, they would add simply in quadrature, but we don't know the correlation. So therefore, the two inequalities at the bottom, it could be as much as the sum of the standard errors together in the case that they're perfectly correlated. Now, notice also this has some implications for the idea of hallucinations because you see most results in AI are not quoted with an error bar. I call this the 42 problem. If you're familiar with the Hitchhiker's Guide to the Galaxy, the computer Deep Thought came up with the idea that the result that the answer to life, the universe, and everything was 42. Well, as a physicist, it would have to be 42 plus or minus something. And you see the result that AI is spitting out to you may seem odd, but it may actually be within the 95% confidence interval, which it did not quote to you. So I'll talk about how to develop that. To develop this on the right-hand side, you can see just a year of S&P 500 closing prices. And we'll do a strategy where we're going to buy the futures. And so the third column there is the value of our portfolio. So then we can, on the bottom, show what the index does. And on the next slide, we can show, we can compute the log prices for the P&Ls. So let me just take a step back on this and talk about Basel and VAR. So in the writing of our textbooks, we certainly looked carefully at the way that the supervisor looks at VAR and has nice tables of type 1 and type 2 errors because essentially every day is a Bernoulli trial. And so we can use the properties of those to figure out, false positives and false negatives. That's great, but VAR is reported again with no standard error. So a really conservative VAR would be VAR plus two standard errors or three standard errors, right? That would be more important than just seeing whether the mean VAR of the sample is that. To codify this problem a little bit more in terms of statistics, VAR is essentially an order statistics. One can argue that it's the first order statistics, that's the minimum of a set of assumed IID random variables x sub I. Why is that? Well, VAR is sometimes quoted with a positive sign. Of course, it's a loss. So if you put the sign in front of it, it's likely one of the, largest negative numbers that you have of your P&Ls. Um, you can take that to the percentile, sometimes called the 99th percentile. Of course, it's really the first percentile of the distribution, one of the worst losses. I'll give you the formulas in a minute, but I've used them then for the tail of these S&P 500 daily log returns. This is the strategy I stated a minute ago, that the way I'm going to get exposure to this is I'm going to buy S&P futures at $250 a point. So I invest about $1.2 million on January 1st, and then I do day to day. So the chart on the right shows the loss tail, which is the left tail of the distribution, worst losses, and so on. The vertical axis, you can see there are very few days when there are these huge losses. And so as a result, the determination of VAR at 95% and 99%, the mean value, let's take 95%, for instance, uh, you know, the mean value is something like 18,000. But when you use the standard error formulas, I'll introduce in a minute, you get this very wide green double arrow there at the bottom. Sorry, it must be I'm reading the wrong one. The top one is 95% VAR, and it's even color coded. That's the orange one. In the case of 99% VAR, the loss is 30,000. That's the mean value. But when you use the sampling distribution, you realize it could be as bad as, like 1.5 times that. So, okay, so the 99% VAR in particular has very high dispersion because there are only 250 data points. So how does this all relate to the formal statistics? Let's go to the next slide, please. Okay, so first of all, there's a particularly beautiful result in statistics that if you simply know the CDF and PDF of a distribution, you can calculate the PDF of the first order statistic of the minimum. It's a function of n, the sample size, and you can see the CDF and the PDF. It's a beautiful statistic result. It's not that applicable because normally one does not know what the empirical sampling distribution is. However, by a similar manner, we can determine the standard error of particular quantiles. And in this case, then we can directly apply that to get the 99% and 95% percentile errors. So again, this is the sampling error of a statistic. Now, I know that VAR can be quoted at 95%, but that 95% result can have a 95 or 99% or 90% sampling error to it. And there are some examples. I applied this formula before for the case of P is the probability of quantiles. So P equals 1/2 or 50% is the median, and we can calculate the standard error of a standard normal. Let me also say that you may be more used to the formulas in the table on the right, which are the standard errors of a mean and a standard deviation. In the left column, I show you the population statistic, which I'm trying to estimate. In the central column, I show you the UMVU, which is the, I think I can get this right, but basically it's an unbiased statistic. So the mean you recognize is just the sum over the number of things, and S there is the sample standard deviation. So the standard error bar for the mean is just the standard error over the squared of n. Sorry, the sample standard deviation over the squared of n. I can drill a little bit more into the standard deviation formula and why it's approximate, but it basically comes out of the fact that it is not simply the square root of the variance of standard error because of Jensen's inequality. So, and then note that they're both of the same error in the lower box. They're both of the same order, but standard error of the standard deviation, sample standard deviation is a little bit smaller. Okay, so we're going to use those results later because we're going to be talking about things like Sharpe ratio. So next slide, please. Okay, so I'm going to apply this then to a portfolio. These are results with my Columbia University intern who worked for me last summer, and took both a standard approach to portfolio management and a AI approach, the hierarchical risk parity allocation model of Lopez de Prado, which essentially reformats and reanalyzes the matrix to find the stocks that correlate with each other and the stocks that don't. If you're familiar with this or with linear algebra, the problem with these large, this is a 15 by 15 problem, is condition number, which means the ratio and absolute value of the largest to the smallest eigenvalue. And an arbitrary selection of, let's say, large cap stocks often can have a large condition number. It means, going back to what Peter said before, that you can have a large amount of noise in those small stocks or small factors. So HRP essentially promotes the stronger factors and and especially the ones that correlate with each other. Anyway, that's in his book on active management of stocks. Okay, so how can we put this all together? Well, we want to then calculate the Sharpe ratio for this portfolio. We did it over the 2015 to 2025 period, as it says in the second bullet, and we use monthly returns. And so basically, if you're not familiar with Sharpe, it's the mean of the excess returns to the risk-free rate over the standard deviation of that. But we're going to add the two standard errors because we know how to take standard errors. So then the table at the bottom summarizes the results. If you don't have any standard errors, you just look at the column called original prices, and you get about zero point 0.3 for a Sharpe for MV stands for mean variance. So that's the Markowitz type of quadratic optimization. And HRP is this method identifying the large eigenvectors and so on. And that gives more like 0.2. But some interesting results come when you look at two standard errors. Namely, the HRP or AI approach is actually consistent at 95% with zero Sharpe ratio. And the Markowitz one is consistent with a Sharpe almost twice as large. So these are the kinds of things that if someone is telling you the Sharpe ratio is something, even now, right, you could apply these even outside AI, you should be asking, what's the standard error of that, right? Maybe you already do. So next slide, please. Okay, so there are other risk metrics. I guess this is my last slide, so you can relax and we can go to comments after this. But let me go through this. The Shortino ratio adds an indicator function of RT, which is a target return, which could be zero, it could be a S&P or something. But essentially what we're doing is we're accenting the downside risk. If we're only counting the contributions to variance or standard deviation when we miss the target. So that's a conservative estimate. Another one that's commonly used is a look back to the recent high water mark. And then, right, the cursor Peter put cleverly right there. It's the drawdown. It's basically how much have you lost since your last high water mark. So I give an example of that. I'm putting drawdown not in percent because the return is in percent. But a drawdown greater than 0.1 is definitely a sign of trouble, and investors will complain. A drawdown of more like 0.2, well, this is an old joke in an American book for kids. What time is it when an elephant sits on your fence? It's time to get a new fence. So if your hedge fund draws down 0.2, it's time to get a new hedge fund, usually, and the fund may have to close. Just to get a little bit into how that works on the buy side, there's a compensation model called 2 and 20, which is pretty common. No matter what the portfolio does, 2% of assets will be your annual payment, just like in a mutual fund, like in a stock picking mutual fund. The ones that are benchmarked, are lower. But the key thing in a hedge fund is that you get 20% of the upside performance goes to the portfolio manager. So behaviorally, that's thought to be an incentive for portfolio managers to grow the portfolio up, where really a hedge fund manager will make money whether they grow your assets up or down. Of course, if there's less of your assets, they'll get less fees, but it's not a direct incentive. Um, and then just to tie this all together, when there's a drawdown, you as the investor, you don't have to pay that 20% fee anymore until it gets back, until you get your money back, until you're made whole in the sense that it goes back to the high water mark. So I think the next slide is just a picture of me and summarizing my contact information. And so we can go to that. It's dense, but there is a QR code to get in touch. I think we still have, what, 5 minutes left if we want to open it to comments, I guess, on what Peter spoke about and what I spoke about. I'm happy to respond.
So thanks, Jonathan, for these insights. And it seems that both of our presentations somehow indicate the sort of caution you have to access whenever you use AI within financial markets. I mean, this is from a model risk manager's perspective. I mean, the usual way to go. But maybe a question from my side. Do you think that given all this noise within financial markets, and I mean not noise in the sense of something we somehow can unmute or get rid of, the noise is there. Do you think that there is a chance or a strategy for AI or machine learning to get better in this area?
So the types of things that we're seeing in my consulting practice is we've spoken to some of the large U.S. hedge funds, and they're definitely early adopters of things like LLMs because they have a dimensionality problem. They basically want to invest in the equity universe, and it's very difficult to pick the stocks. I discussed two approaches, neither of which is really optimal. So I think there's a place for doing with them. The problem with that is governance, largely, and hallucinations, data drift, so on and so forth. So, I mean, I think they've already answered the question because there's been a lot of adoption of this. But, there was a lot of adoption of driving cars before there were seat belts, airbags, and guardrails. I
Mhm.
think it's for us, the consultants, perhaps, and for academic research to try to figure out, how this can be done in a way that people don't get hurt. And so that's what our focus is now. And part of that, and like the proposal that we put in for a large hedge fund, is to use things like watch the language of the LLM and see how that's changing in much the same way as an annual physical with your doctor. They might see something as an expert that is, a spot that might be cancerous and things like that. So maybe you can catch something on the way to the hallucination before it fully gets there. That's the hope.
Mhm, mhm. And I also think that, and this is my perspective, um, once you leave this realm of numbers, if you leave the realm of classical time series analysis, then some of these ML or AI techniques play out their full strength. So that is also, I think, a way to take into account ever more data in order to see how we can improve risk forecasts. And maybe one last point. I once did some experiment where I just said to our on-prem large language model, just try to figure out how to, based on the available literature, of course, try to figure out how this could be done in an agentic fashion to compute risk, time series based market risk. And more or less, they came to the same conclusion as we did today. So maybe there needs to be some human injection of new ideas how to make AI more successful within financial markets time series. And yeah, I think we are on a good way, but at least from my side, I'm working in the risk controlling unit here at DZ Bank in Frankfurt. So I'm mostly on the more risk-focused side or model risk-focused side on the stuff. I see there's still some way to go in order to successfully apply AI within market risk. At least that's my take at the moment.
Yeah, I agree with that. And as I said, I was driving around Brooklyn today, so I didn't get all of Joe's remarks, but I saw Joe speak recently in Toronto, especially about human in the loop. And some of this is Joe Breeden, who's running the conf, as most people know. So the idea, can the human be used? Does AI make more or fewer mistakes than a human? Uh, would you know the difference between AI making mistakes and a human making mistakes? And questions like that, I think, are kind
Mhm.
of
Yeah,
fruitful.
yeah. Okay, so thank you, Jonathan, once again for taking part in this discussion, and thank you all for listening to our thoughts.